Let's talk about a company that's pretty much everywhere, but you've probably never really noticed it. It's a massive global giant that's hiding in plain sight. And, from an investor's perspective, it's one of the most interesting industrial companies out there.
Seriously, just think about your days so far. When you locked your front door this morning, swiped your key card to get into the office, maybe even opened a locker at the gym. Every single day, we put our trust, our safety, in these little mechanical and digital gatekeepers without a second thought.
And here's the crazy part. There is a very good chance that the lock you just used was made by a brand you definitely know, like Yale or Kwikset. But what you probably don't know is that these household names and literally over 200 other brands are all owned by one single massive company, ASSA ABLOY.
I mean, we are talking about the undisputed world leader in everything that opens and closes. They have a truly colossal footprint. So the big question for us today is, how on earth did they build such an incredible fortress of a business? And, maybe more importantly, does that dominance make it a smart investment?
To answer that, first we need to understand its competitive advantage, what investors like to call an economic moat. And let me tell you, ASSA ABLOY's moat it's wide, it's deep, and it is brilliantly designed.
Now, this right here, this is the secret sauce to the company's stability. A full 2/3 of their sales don't come from flashy new construction projects. Nope, they come from the aftermarket. Replacing old locks, upgrading security systems, and all the servicing that goes with it. This makes the business incredibly resilient, because it's not totally tied to the crazy boom and bust cycles of the construction world. And what feeds that super stable aftermarket business? It's this concept, the installed base. The best way to think about it is like the old razor and blades model. Every time they sell a locker or a door system, they're not just making a one-time sale. They're basically locking in a future stream of high-margin revenue for years, even decades. Because when that lock finally breaks or needs an upgrade, who are you going to call? Probably the company that made it.
So you can see how all these things just feed into each other. It's a beautiful self-reinforcing loop. The strong brands lead to more sales, which makes the installed base even bigger. Their massive scale gives them huge cost advantages over anyone else. And their expert-level knowledge of complicated building codes, that just makes it incredibly difficult for any new competitor to even get in the game. It's a perfectly designed fortress.
But here's the thing. This fortress doesn't just sit there defending its walls. It's constantly expanding. So let's look at the powerful, disciplined growth engine that's always building out its territory. Just look at that number, 400. Since they were founded back in 1994, ASSA ABLOY has acquired nearly 400 companies. This isn't just a random shopping spree. This is a systematic, programmatic growth machine. And this is where the real genius of their strategy lies. Every time they buy a company, they aren't just buying that company's current sales. They're buying its installed base, and then they plug that base right into their own massive aftermarket machine. It's a brilliant way to create a long tail of future, profitable revenue.
But it's not all just about buying other companies. They pair that aggressive acquisition strategy with a huge commitment to building from within. So they buy on the outside, like the 24 deals they did just in 2023, and they build on the inside, plowing nearly 6 billion Swedish kroner into their own R&D. It's this powerful two-stroke engine that just keeps chugging along.
And that R&D spending isn't just for show. It gets real results. The company has a goal to get a quarter of all its sales from brand new products. And in 2024, they came in at 23%. This is proof that they aren't just some dusty old holding company buying up brands. They are a real technology leader, always pushing their products forward.
Okay, so the business model is great, the growth engine looks powerful, but as investors, we always got to ask, right? Does it actually translate into strong financials? Let's dig in and look at the proof.
This table tells an amazing story of resilience. Okay, look at 2020, the absolute height of the pandemic. Organic sales fell 8%. You'd expect that, right? But check out the next line. Acquired growth added 4%, which really cushioned the blow. Now, fast forward to 2024, and you see that same engine just humming along. Acquisitions are driving growth, even when the organic side is a little flat.
And through all of that, look at the profitability. Their operating margins are just remarkably stable, always hanging around that 15 to 17% target. For a massive industrial company like this, that kind of consistent high profitability just screams high-quality business and strong pricing power.
Get this. This quote is absolutely incredible. Even when their sales volume dipped a little bit in early 2024, they still managed to deliver a record high profit margin. That speaks volumes about how well management can control costs and run the business no matter what the economy is doing.
And it all comes down to cash. In 2024, this business spit out over 23 billion Swedish krona in operating cash flow.
That right there, that's the fuel for everything. It funds the R&D, it pays a growing dividend back to shareholders, and, you guessed it, it finances the next wave of acquisitions that keeps that whole growth engine running.
Okay, so we've seen the fortress, and we've seen the engine that powers it. Let's pull it all together now and really weigh the core arguments for and against this company, looking at it like an investor.
The bull case is pretty clear, right? You've got a dominant market leader with a huge moat, and it's riding these big, long-term trends like the need for better security and smarter buildings. The bear case, though, it's real. The company is exposed to construction slowdowns, there's always a risk when you're trying to integrate a massive acquisition, and you've got the looming threat of big tech trying to get into their space.
So these are the specific things an investor really needs to keep an eye on. How are the housing markets holding up in North America and Europe? Can they actually deliver the $100 million in cost savings they promised from their biggest acquisition ever? And, critically, can they fight off competition from tech giants while making sure their own connected products are safe from cyber threats? Which really brings us to this final, crucial question. ASSA ABLOY masterfully built an empire, a fortress of steel and brass that has dominated for decades. But can that same fortress, that same economic moat, defend itself in a future that's going to be defined by silicon, by software, and by data? That, right there, is the multi-billion-dollar question.